Hi, and welcome back to the Mirae Asset Sharekhan channel. Here with us, we have the three specialists of Mirae Asset Sharekhan when it comes to research. Firstly, we have with us Mr. Gautam Kalia, Mr. Somil Mehta, and Mr. Binod Modi, who are here to guide us some of the most pressed questions that you have on the Indian stock market and to give us guidance on how to maneuver through these volatile times. Thank you so much, three of you, for joining us and helping us through this very difficult time in the stock market today. Okay, so we're going to just jump straight right into it. Firstly, everyone wants to know, how long is this global crash going to last?
I think for me as a technical analyst and looking at the derivatives data, I would say that for the medium term outlook for the next couple of months would be a little difficult. There's a lot of uncertainty at this point of time, and the details definitely will not be an expert to give you more details about it. But looking at the charts, lower top, lower bottom formation, the higher time frame momentum indicators have been in sell. There's a very sharp sell-off, so it's not going to be a V-shaped recovery. I would say that we would base out a little bit in these areas in around 22,000 or 21,000 area, and then this base out pattern will break on the upside. This is what my take is on the entire market. The worst case scenario from here is on the downside would be 20,000 or 20,500. However, to be very clear at this point of time, the start of the show, that this is a golden opportunity to get into large cap stocks. Value buying would be preferred from here.
So I would just like to continue his points. What he said in charts, market looks extreme volatile. I believe the basic principle of any equity market is it does not like extreme uncertainty, because high uncertainty, it always leads to higher cost of equity, leads to higher equity risk premium, and so lower valuation. So given the fact that President Trump has already imposed reciprocal tax to various countries, and I believe that here on that some risk that might be arising in the form of all these nations, how they are going to act in terms of reconciliation or retaliations of the tariff, B, what the kind of impact, or I would say the quantum of impact to the global economy, and C, what would be the possible earnings cut in domestic equity market. So these are the some uncertainty would continue to be there in in the near term, or I would say in ensuing months. So definitely market does not like this kind of uncertainty, and I believe market will remain volatile because of all these things. And but within that, I think there are some sort of brightness we have to focus upon, like that I would say because of all these things, we have started seeing the dollar index which started cooling off, right? Bond yields which came down significantly from the top, and against the crude, which again looks to be a downtrend rally. So these things would ultimately help India. But overall, how market can react in the near term to medium term, definitely in the near term, it appears market will remain volatile. But definitely the way we have seen kind of correction over in last 2 days, right, market corrected significantly in response to this tariff hike. I believe the extreme downward correction might not be here on, because the market has already been correcting. If I just keep aside the March month, where market recovered almost 7% point, I think since the month of September, October, market has been on downtrend trend, and after seeing such kind of correction, I think market valuation at one point of time, I believe, looks to be reasonable as of now. And probably that is the reason I don't expect market will see significant correction. But yes, directionally it appears as of now, because of how uncertainty here, I don't think the market will see secular rally, at least in the near term.
Got it.
Gautam, do you have any insights on the long term?
Yeah, sure. So let me just quickly answer the short term. If you look at it from a long-term investor's perspective, the markets always surprise both on the upside as well as the downside. So it could very well be that over the next 6 months to 1 year, the market surprises on the downside and continues to crack all support levels. So that is something that the long-term investor needs to be aware of. And when you look at rallies as well as collapses of stock markets across the world, and you look at history, you'll see that correction periods of market correction or consolidation are typically last twice as long as periods of market rallies. So we are at that phase where we've seen about 6 months of markets correcting and consolidating, and right now you see a lot of investors putting on a brave face saying that okay, long term, because they've probably seen their portfolios crack about 10-20%. But when that 10-20 becomes 30-40%, and you'll start seeing news flows of retail investors panicking, that's something that is happens very often. So that kind of a scenario can also play out, and we as long-term investors should be mentally prepared. Keep that in mind. Obviously there are so many positive things happening for India, with rate cuts imminent, with commodity prices, especially oil, at $63, which is very cheap. So all those things are actually going to help us, right? And to a large extent, we are not impacted so significantly because of the tariffs. Maybe one or two sectors which we'll cover. But otherwise, broadly speaking, and obviously our consumption base also is fairly strong. So broadly speaking, I think there is definite room for the market to bounce back as well. So we have to keep these things in mind. From a long-term perspective, I would say that you're getting attractive valuations to invest in. If you can invest in a staggered manner, please do that now. If it continues to correct, then keep putting in more money. Keep that 5-6 year view in mind at least, and don't panic, because that's really what such markets will end up triggering as a behavior in investors. So that's something that we have to just be wary of.
Of course. Got it. Thank you, all three of you, for that. So moving on also, so how do we see Trump's tariffs policies and the current US market functioning trickling down into Indian markets as well? Should an Indian investor actively look at those markets and understand where it's going to go because it's a strong mirror image of it, or how do we look at this exactly?
For me, I think he'll be more he's an expert on this, but if I have to look at this, what President Trump has done, he's trying to do the right thing. The only thing which is wrong is that he's trying to do it very quickly. He probably should have. I'm not an expert, but he probably should have done it slowly and one by one with countries negotiating upon the tariffs. This is what my thought process is. But he's doing the right thing for me, and it is good for US. It's good for us as well, because if he's going to pass on the tariffs to China, then probably we are going to get the opportunity in that sense. So that is a long-term story. It's not going to happen very right now within a couple of years. It's a long-term story, and we are going to get all the benefits out of it.
I'd say, I think indeed it's very difficult as of now to quantify what kind of impact, how much impact would be there for Indian economy and global economy. It's very difficult. But I think in terms of what as of now is there for India, if I look at, while the overall, if I look at India's export to USA market, overall it accounts for almost 19% of total exports, right? Whereas in what India imports from, USA, this is just hardly, 7%. So clearly, if I consider 19% export part, that looks to be meaningful, though India GDP accounts for just 2% of, total exports to USA from India side. So I think 90%, if I consider export part, that looks to be significant. And I was just reading some of agency GTRI, I think 2 days back, which came out one report and said that because of this tariff part, I think in India will see, the impact would be around, $5.7 billion, something like that. So to my understanding, $5.7 billion for this calendar year, I think it does not look to be that meaningful to be, but yet I still say it's very difficult as of now, because there will be some percolating impact to other sectors also. So I think as we as month passes, we will get to know what kind of actual impact would be there. But these are the things, the impact part. But more or less, I think I'm still trying to find out what would be the positive part that India can take or get out of this the tariff tantrum part. Yes, there are countries which are seeing higher tariff relatively, be it China, Vietnam, other countries, right? So clearly I see there are some advantage for India, right, going ahead. And I believe there are some small value sectors like I would say sectors like we can say textile, right, footwear. This industry, I think for this industry, India would be clearly benefiting over the long period of time because of relative a differential of the tariff with which other countries. So I think those part I am looking positives coming out for India over the long period of time. But overall, I think for near-term perspective, there will be some sectors which I believe might be impacted because some sector-specific sport-driven, sectors like companies, rather automobile or auto ancillary companies that might impacted, because companies like Bajaj Auto, Balkrishna industry, they see significant portion of their revenue from the export market. At the same time, there would be chemical stock which might get pressure because of all these tariff tantrum part. Their input cost would become expensive. So this will have overall impact on their margin. In addition to that gems and jewelry segment where India export to the US market in a significant way, that also get impacted. So these are the sectors I believe that should get impacted in the near term. But over and above, by the pharma sector, which can still come out with a with sort of winner within the sector part. So for the pharma and for the domestic play, like consumer durable, telecom, or some other defensive stocks, in consumer space, we are positive about.
Got it.
I have a slightly different view and maybe a little bit more in line with Binod, that it's a developing situation. Now, because it's developing, right, we don't know the end game here. But it's clear that Trump is essentially, taking. It's basically a war against China, between US and China, right? And everyone else is to a large extent the innocent bystander that is going to get impacted. Right, and if you look at the news, the way it's developing now, China is restricting exports of rare earth elements. Right, so that is a reaction. Right, by tomorrow we'll come to know whether China backs off or faces the 50% tariff that Trump has warned them about. So with every passing day, you have some news that is developing. So the downside risk for any investor is significantly higher. So the volatility is there to such an extent that the probability of downside risk is magnified. The probability of upside is also extremely high, because yesterday we saw that there was a rumor in the market that Trump is putting a moratorium on the tariffs. There was this rumor that was spread that for 60 or 90 days the tariffs will be delayed. And suddenly the markets bounce back, right? Which means that there is a lot of liquidity, a lot of money waiting on the sidelines to be pumped in.
Right.
So that I think that volatility will continue to persist, and you could very well be in a scenario 3 years from now where you call this the Great Financial Crisis Part 2, because that's how GFC kind of unraveled in 2008. It took days like yesterday, and many days like yesterday happening over a period of a year and 2 years for us to then get the perspective of GFC. So this could very well be government credit risk, unwinding, and the start of it. So that's why I would say that we have to be cautious, and we have to invest in a staggered manner. Not so. Look at what Warren Buffett is doing, right? He's been sitting on cash for so long, and he's not putting all that money in immediately. So that's probably a good analogy to keep in mind.
Yeah. No, that definitely does make sense. And since we've been talking a lot about sectors and different sectors which are affected or not affected by Trump's tariffs, I just want to touch base on that. Like, what do you all think are currently safe havens as sectors to invest in right now in the Indian markets? And what do you think are sectors which people should avoid in the near to medium term future in terms of volatility and downside?
Let me start on this, and one sector which I would like to avoid, that would be IT, because IT has just started the downside, and it has cracked below some very crucial levels on the higher time frame. And that is a very negative sign overall for IT sector in the coming years. In the next probably couple of years, I would be expecting correction downside, maybe from here 20-25% more, and maybe time-wise correction would be more painful. Price-wise correction would come in very quickly, probably in next couple of months. But the time-wise correction would be more painful in the next coming 4 to 5 years. Then the entire industry will restructure, and with this tariff thing going on and the impacts in the next couple of years, all of this will wind up, and then the industry will restructure, and then will start a new upside. But for these couple of years, or maybe more than couple of years, this industry would see a time-wise correction.
Got it. So IT is one industry which maybe. Yeah. And the ones which look favorable to you, like?
Favorable, as Modi said, that consumption theme looks great, and I would
India's story as of
yes, 100%. Everybody is talking about consumption, and I'm not unique. I'm not talking about the same thing. And I would like to press upon one thing, that is, we should be looking at large cap stocks at this point of time. I would avoid mid cap stocks, and I would avoid small cap stocks definitely for the next at least couple of months, because there is a lot of uncertainty at this point of time, and I would like to see the large caps first basing out and then starting the upward rally. And the large cap stocks probably would be ITC, HUL. These are all large caps, and where the consumption is a little newer, probably would be Trend. Is one of my favorite in that area. So I would say focus on large caps, start accumulating large caps slowly, one by one, in this uncertain times, because this is a golden opportunity. Markets are down by 25%, Nifty is down by 25% almost. And I think even if the market goes down by 30 or 35% more, 5 to 10%, it will be a time for a long-term investors to accumulate these large cap stocks which are based on consumption. But yes, consumption, large cap stocks would be my preferred.
Got it.
So honestly, if you'll ask me, if there would be sort of full blown trade war, all sector will get impacted. Whether some sector will be directly, or maybe some sector indirectly will get impacted, but all sector. But within that, you will have to take a bet. I believe BFSI is one space which looks to be very good, and BFSI is, again, it's a heavyweight index. So I think.
And you're not saying this because you're a part of Sharekhan.
No. It's not genuinely. I mean, if you BFSI, if you look at a valuation wise, there is some sort of comfort from the valuation side. Most of the stocks, barring few, they are trading, at lower than their historical average, and we are seeing whatever is there as of now. But one thing is very clear, that the FY26 we might be seeing that the Indian economy would be seeing, decent growth vis-a-vis most of the nations globally, right? So I think RBI started, cutting rate, oil is in our favor, right? Domestic consumption, which is expected to, pick up, of course, thanks to the budget thing which government had, given to most of taxpayers. So because of all these things, I think and the corporate capex also picking up. So considering everything, I think banks looks to be in a good space, given the fact that their loan book should be better compared to FY25 last fiscal. Their asset quality has improved of late. So considering everything, I think this space one has to focus upon, right? In addition to that, I believe pharmaceutical is a space which also looks to be better. Within pharma, I believe though there has been some sort of talk that Trump would be again coming and impose higher tariff to pharma companies, pharma exporter companies, but I don't think so that's going to happen, because USA also needs their consumer also needs medicines at a lower price, right? So which is a very sensitive topic over there. So I don't think so pharma will get adversely impacted because of all this part, despite irrespective of tariff. But I don't think so as of now tariff would be higher for pharma. So that is why we like pharma, especially those pharma which are more exposed to domestic market, Indian market, right? In addition to pharma, I would be I would like some companies or sector, I would say, which are purely domestic player. Likewise telecom, right? Telecom, we are seeing consistently these companies are able to take price hike at consumer level. So I think there are again the talks are there, then in coming months they would take another price hike, right? So that will continue to support their overall ARPU. And companies like Bharti Airtel, these companies over the next 2 to 3 years is going to generate more than 1 lakh crore in terms of free cash flow. So you can understand the kind of cash these companies would be generating. So we are very much positive upon this space and these companies.
Got it. Done. And like you rightly said also, that sometimes during certain market moves also there are no industries or sectors which are safe from it. Like we saw yesterday also that everything was in red. So anything you would specifically recommend to avoid, at least in the short to near term?
Yeah, in the short term, as I said, the companies which are directly exposed to export market, one should avoid as of now. I think although I already named, there are some companies, Tata Motors, also BKT, these are companies, they are directly exposed to export market, and because of higher tariff their business will certainly get impacted, right? So there are some space, so chemical I also took some good names, SRF and all. I think many of companies which are directly dependent to China as well as the USA market for their export. And as I said, in coming month you will see because of all this tariff part, their input cost, because the most of the inputs they get from the export by import, right? So this will get expensive, so that will hit their margins, right, going forward. So this one space I think one should go underweight as of now, considering the tariff part.
Got it. Understood.
I just wanted to add, I completely agree with both of them in this case, because for the last year and a half we've been telling our clients, we've been large cap bias portfolio, go to its quality, over moment, and maybe we were a little bit early on that call, because we've been doing it since early 2024 or even late 2023. So for the first 6 months of 2024 we were on S&P, but now obviously although on that advice, all that guidance in the portfolio, making the portfolio more resilient. And that's really what you need to have now as an investor. You need to have a resilient portfolio that protect you on the downside, and that you can only get by having a quality bias and a large term bias in your portfolio. Even multi-assets, the basics of having good asset allocation. And because just with good asset allocation, you can have automatic allocation now getting in the income tax, right? So with interest rates coming down, that's a good news for that as well. So I think these are things that we all investors need.
Yeah, I think that's a great insight. And the next question is actually, I think, a little bit suited right up your alley. So let's say if you're an Indian investor with some disposable income, as we've seen there have been some tax reliefs within the country itself. So where should this investor be putting their money ideally during these times?
I think if you are a new investor, please build a portfolio now. Buy a SIP in mutual funds with a large cap bias. We had ready-made portfolios available of IPC funds that like since start of it. And if you're comfortable in looking for long term and comfortable with risk, then you can even do an all-equity portfolio. Since you're already investing in a staggered manner, that can be a fantastic opportunity for a new investor to build a portfolio. If it is an existing investor, even you carry some baggage as an existing investor because you're thinking about your peak value in your portfolio, for my entering bias rate that you get over, and the fact that you have certain schemes in your portfolio which will impact your decision making, even though it shouldn't. But for existing investor, I'd say please continue your SIP. Please increase the value of your SIP. Please look at funds that are working in line with the benchmark but have a more quality or a large cap bias or more defensive bias. And that's actually what we did recommending for the last year or two or like. And that's what I'll say for them to continue. Please don't stay away from the market. That's the one thing that you should not do. That's the one right. I would tell you a good time to embrace your investment in market.
Yeah, and just to understand a little bit more from an asset allocation perspective, since we've spoken quite a bit in this talk also about crude oil, gold prices, etc. How should an investor balance their portfolio amongst equity, debt, oil, gold, indexes, etc.? What would you recommend is a right balance?
Yeah, so ideally speaking, most investors, if they're looking to create all-weather portfolio, they should follow the basic principles of active allocation. Company has rudimentary 100 minus H to becoming a allocation. Right. So you should follow that. If you're an employee, then you're already practicing that because of your contribution in the PF. You already have some net allocation. Unfortunately, I see a lot of investors with a 90% plus allocation to real estate because they no primary residence. But otherwise, what I would say to most investors in please follow asset allocation. Not just because asset allocation point now look good on paper because of the return. They were 3 or 4 years back, asset allocation fund were not looking good. No, this is return. But those are cycle. And asset allocation works out because it's tax efficient and reallocation is happening automatically. And over the long term, it provide you superior risk adjustment return. Right. So they are more like village effort kind of product. Right. If you're not keen on asset allocation and you still want more return, riskier thing, then you can go 100% equity. Right. As long as you're in the accumulation field of your life. Right, then it probably makes sense. Could you always have that dry powder to kind of value average on your part? Yeah. That's why I would say that's an option for people who are in that accumulation fee. Right. From the head.
Got it. And let's say for someone, as an example, someone my age who is looking to restructure their portfolio correctly, would you recommend taking money out of equity and putting it across other asset allocations during these volatile times where the Indian stock market is a little bit more volatile compared to the past 3 years? Or would you recommend just sticking to my equity allocation as of now itself?
You have to invest with the perspective that you got about 4 decades ahead, right? So with that perspective in mind, your initial task should be to build out a 4 portfolio and not focus on a tactical allocation. And your portfolio purpose itself is not large enough. Core portfolio comprises your multi-asset product, the large cap bias portfolio. To really just focus on investing there as much as you can. And that's really what you need to do. Right now with unless you are looking at the multi-bagger over the yes. So hopefully just rely on your fund manager to find that multi-bagger for you. So just do that right now. I think
Volatility is the price of admission.
I think I also advise. I think just to add on to this, I would prefer if I was your age, if I was your age, I would like to take more risk. No, yeah, I wish I was, but yeah, if I was your age and if I was younger, I probably would take more risk. If I was within 20s, early 20s, or even late 20s, I would take more risk. I would like to go into value mid-cap stocks, value large-cap stocks, 60-70% of my portfolio being equity, holding on to that for a long period of time. As you grow older, probably after 30s, you have responsibilities, you have more things to do, you have more bills to pay, right? So you'll go into more safer assets like probably mutual funds and debt and all of that. When you get out of your 50s, when you cross your 50s, I think that's where you go fully into very safe haven area where you'll be investing in debt only, where you're getting a little bit more returns than fixed deposits. Yes, so at your age, I would take more risk. And what the side?
Binod, would you have anything to add as well to this?
I just want to add here, I think what I understand, after reading through lots of, books and all, I think whatever your age is there, I think that has to be, subtracted from 7, and whatever figure comes, I think that exposure in equity you should be having, right? Let's say if you are 30 years old, right, 70% your total, investment should be in equity, right? And definitely, as I said, as Gautam said, ki SIP for the all newcomer investor, SIP is the way wherein you can build your overall purpose. I think that's the right strategy, because of course that's being managed by all professional. And as far as direct equity is concerned, definitely you should have at least 20 to 25% of your total investable amount to understand, to get a kind of sense about the market. And of course that has to be more towards large cap names, right? And within SIP, if you are choosing SIP, I believe your SIP should be in the right combination with large cap as well as the multi cap strategies.
Right, got it, done. I think that's a lot of personal advice for me as well on what I should be doing with my portfolio, but we're just jumping ahead. So the next question we have is a very, very widely asked one, is if the Indian stock market currently is on the overvalued side, and at what levels or at what time are we seeing or looking at this to correct?
Clearly, at my initial remark, I said, after seeing, correction consistently from the month of September up to, barring March, at this level, market valuation looks to be reasonable. On TTM basis, if I look at Nifty's trading almost 20x as of non-TTM, so that is very, reasonable, or I would say attractive to me. Or even on 1 year forward basis, it's trading almost 19 times, which is at par, I would say, little bit discount with its historical average. So clearly, there is no doubt as of now that the market can't go ahead or see further up move, given the fact market needs some sort of clarity. And as I said, clarity will be coming only maybe take 2-3 months or a quarter or 2 quarter, unless we get to know what would be the actual kind of impact to the corporate earnings and all. But mark my word, as I said, Indian economy still looks to be in a very good position, given the various tailwinds that we are seeing. The Nifty earnings, I believe, still tends to see 12 to 15% kind of growth. FY26 and FY27, I still believe it will continue to see double digits earning growth. And as of now, I don't see or any major market which can consistently grow at least next 2 to 3 years in a double digit world. So that clearly favors Indian market.
Got it.
I just like to give the example of a client. Imagine you're a client with a 1 crore market value portfolio right now, which is down from 1.3 crore or 1.8, and you're sitting on 50 lakhs cash. So don't put in your 50 lakhs, sir.
Okay.
Like you see that the market is, let's say, paying value.
Yeah.
Right. So purely a valuation, market can go under value again.
Yeah.
Or it's a development situation. Maybe for start a SIP of 5 lakh or 10 lakh.
Right.
And take a call out of the situation develop. That's probably the way to go.
Exactly. Your investment should be in a staggered manner, as he initially said.
Yeah. Got it.
Just adding on to that, from my perspective, like technicals, there is nothing called oversold or overbought. Okay, people keep saying there is oversold, now it is a oversold territory, and now we should keep buying. There's nothing called oversold or overbought. Stocks, if the stock is making lower tops, lower bottom, it can keep making lower tops, lower bottom till the time it does not hit the right value, right? And once it starts making those basing out patterns, and then turning back upwards, that's the time it has actually started the upwards. So there's nothing called overbought or oversold. So if you think there is a stock which is not as good as it should be, then it's best to get out of that stock, whether it is a large cap, mid cap, or small cap. But if the stock has already corrected at a certain level and is starting to base out, still it's there in a area for a little while, and it has started bouncing back, that's the time when you get into that stock. And not, of course, we're not here to catch tops and bottoms, right? It is foolish to catch top and bottom, especially when the markets are going down.
Yeah.
You can't catch the knife, right? It's very stupid. So wait for that basing out pattern to happen and then go up. When I say that this is a golden opportunity to buy into these large cap stocks, there are stocks which have already corrected 60-70% already, and these stocks are now trading in a broad range. The ranges are big, but these are trading in a broad range, and once there is a stability in these range and it starts going up, that's the time we will get into these large cap stocks, and that's when we actually make money. And one more thing I wanted to add is that mid cap stocks, that's where you make that alpha in your portfolio. You don't make that alpha from large cap stocks. Large cap stocks will always give you that balance, that stability in your portfolio, but the alpha will always be made in your mid cap stocks and your small cap stocks. So you start with large cap stock, then you get into mid cap stocks, and then you get into small cap stocks. But exiting a small cap stock and mid cap stock is very tricky, and that's where this SIP comes in and the mutual fund comes in. And if you keep doing that very consistently, I think that's where you will make good money.
Got it. Understood. I think, again, very insightful to understand the current Indian equity situation. But now we're coming to the most basic question which everyone has right now. And I think all three of you have answered in a certain essence, but just to get a clear strategy. Is this a good time to buy into the dip? And should people seriously be considering putting significant amount of money into equity right now? And if so, what would be the right strategy?
I'd like to answer it.
Yeah.
I think the question is wrong. It's the wrong question, and we should never be asking this question. As investors, the best time to invest is when you have the buy, and because you're looking at wealth creation, and wealth creation in equity happens because you're owning businesses. Those businesses are generating profits, and as a result, as a poor business owner, you're getting a share of the profit, and that's really the mindset that you need to have. And I think too much attention is paid on, and here a part of the problem because we are a brokerage house. Too much attention is paid on the timing and the scenario around making when to invest. Really, it's about building that allocation, building your portfolio over time, building your wealth over time. So really, just keep putting in the money, just keep investing and be patient. The market rewards discipline and patience, and that's what we've seen over the last 40 years that our goes in, and that's what we continue to do. And that's really, I keep correcting anyone who asks this question. All of my investors, you need the right time to invest. People, is this the right time to invest? Has the basic assumption under that someone has an idea of what's going to happen tomorrow, right? And like we've already said, this is the developing situation, and there are so many interplays happening that No one can add this figure. No one can predict what's going to happen tomorrow and how the market will react.
Right.
So, you could very well be sitting 6 months from now saying that, we had the a meeting at the interview at the bottom of the market, or that, that was just the start of a fall. Right? It could go either way. That's why I would say it's an unfair question.
Agree. Just to support, Gautam's point, we had done one study, in Sharekhan, wherein we had, taken data of almost 40 years data, right? Market data, and we every year, we invested 1 lakh rupees every year, right? And my, luck was that, bad that the year and the day where I invested, that was the worst day of the market for the particular year, right? But what I did, I consistently invested, throughout the year. But at the end of the, year, let's say last year, 2024, I still made, 12 to 13% kind of compounded return, despite investing my money at the worst phase of the market every year. So you can understand, no one is there to time the market. It's about your discipline which makes you rich.
Of course. So, okay, let me tweak my question, then completely scratch off or ignore that I asked the first part. And I'll stick to the second part is, what is the right strategy to invest with right now? Generally, like you said, it was a staggering investment strategy is the best way to go. But if you could emphasize a little bit more on that, what should an investor do right now? Maybe a new or an avid investor, what should be their stance in the market?
So, start your investment first of all. Don't sit on it. Don't say that, okay, I'll wait for X value. That this, once it breaks this support, then I'll get back. Start. Look for good advice. Don't try to do your own research and figure out steam on your own, because you are getting into the journey for the next decade plus at least. It's a lifelong journey. Even we have clients who are in their 80s and still thinking about the next 10 years. Right? So if you're in your 40s, then you still have 40 years to grow. So don't look at it from a 3-month, 6-month perspective. Seek out good advice. We're very happy to get you because we research on fee and stock. And obviously enter the market with the view of a tidy investment. Don't stay out the market. That's the one thing I would say for everyone who's watching. Don't do that.
Right. Done. Will do.
Little ahead of the box. Probably there is a saying, we all know that the saying is that buy on declines, buy on lower levels or dips, and sell on rise and sell on high prices. Markets are going down. Markets are already 25% down, right? And probably 30% down or 35% down in next coming couple of months, and there'll be a bottom. This is the right time. That's the right strategy too. That would be my strategy, that buying on lower levels and probably selling on the high levels. So low levels are in front of us right now, and large caps are, basing out already. A lot of large caps are already basing out. So this is the right time. For me, as an investor, only as an investor, I would like to buy on dips and then sell on rise. As a technical analyst, that's how I see it. I see the markets. The strategy from the fundamental side would be a little different, probably, accumulating value stock.
Also, definitely your outlook is on the near to medium term future as well, right?
In the very short term, the markets are bearish, and I expect markets to go down till 21,280. That is the election day low, and that is very close to a 50% retracement of the rally which we've seen in the last 4 to 5 years. And that 50% retracement could be around 21,280. So that is where I think the basing out pattern will happen, and that is where I think the correction will end. But the worst case scenario is 61%, which is around 40 monthly moving average, which is around 20,500, and that is my worst case scenario. So this is my medium term outlook and the short term outlook. Sell on rise would be a strategy for the traders, For a long-term investors, of course, buy into large cap.
Keep invested, yeah. Makes sense. Binod, if you have any inputs as well.
Inputs with regard to how
Investment strategy, yeah.
investment strategy, for your strategy should be always have higher allocation towards equity, right? And for that I think everyone need to have saving, because I have seen today's generation, they hardly believe in saving part. So definitely what I can say, money makes money at the end of the day, and you will always would have outlook next 15 to 20 years, where you would like to find yourself after that period, how much corpus you should be having after 20-25 years, let's say. So considering that you should have always with the tendency to save more, curtail your expenditures, invest in equity. Right, and whatever you said is keep on investing in equities by way of SIPs, direct equity. You should have direct equity to the extent of 20 to 25%. Invest in SIP plans. Like you should always have plans like in addition to direct equity, should have also plans like multi-asset funds, which can anyway looks to be very resilient across the cycle. So this is how you can overall build up your corpus and portfolio over there.
Right, that makes complete sense, and I think that perfectly ties up to my last and final question, which I have, not really question but thought I have with all of you all, is if you had one line to give any investor or trader out there as a piece of advice right now, what would that one line be?
And I have to think now. The advice would be to stay in the market. That's what he said. Just stay in the market. Don't get out of the market just looking at the overall surroundings. Don't get out of the market, or don't sleep over it. Stay in the market, stay informed, and then start investing. Keep investing in a slowly. You don't have to be very aggressive in investing, but yes, slowly start investing into equities, debt, commodity. There are a lot of assets which you can now, even in reality, you have online shares where you can keep buying these small units, and then you can keep rolling that. But that's what my advice would be: keep investing, be in the market, be informed.
Right. No, so I can give an anecdote or an example. One line probably won't be enough. So imagine you go to the mall today, you really like a pair of shoes that you want to buy, which are about, let's say, 10,000 rupees. But somehow you decide against buying them today. And then the next day you end up going to the same mall and saying, okay, today I'm definitely going to buy that pair of shoes. I waited a day, delayed gratification, but still I need to buy that. And you go into the shop and you find out that that pair of shoes is available at 50% off, the sale is starting. So now that same pair of shoes is available for 5,000. That's the reality that you need to keep in mind whenever the market corrects. Right? Unfortunately, what happens is that we don't think of that, because obviously we're not going to react in that scenario saying that, oh my god, now the shoes are sellable. Right? Spice on the I now wait for them to go down further to 200 rupees, and only then will I buy. I mean, unfortunately, we see that with clients doing that with top market investing, which is something that we do.
Right. No, I think that's a great analogy and a great insight for value-based investing as well.
My suggestion or advice to investors would be just one line, if I can explain. Don't try to time the market, rather give time to market.
Wrong. I think that's very well put. That's so well. But I think this has been a great and very, very insightful discussion. I think it's given me and a lot of our viewers as well a lot of guidance on how to maneuver through these little bit difficult, volatile times in the market. But as we see, a very great opportunity to stay invested and get into the market as well. So thank you so much, all three of you. I really appreciate you taking out time here and helping us out. And if anyone wants to reach out or has any questions or doubts, please do reach out to us in the comments or message us on Instagram or any of our social platforms, and we'll get in touch with the experts to help you out as well. But thank you so much, everyone.
Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.